Welcome to Real Estate Economics Weekly Webinar Series. Real Estate Economics is a leading provider of residential market consulting services and online research tools. Every week at this time, we post to YouTube in streaming high def a webinar covering a variety of topics to the residential housing industry. This week we also have a special series going covering top residential markets in Southern California. One of these webinars was presented last week, so that's already posted to YouTube, and there are three others. One was recorded yesterday, the Inland Empire. One will be available next Wednesday, October 13th, covering Orange County, and 2 weeks from today, San Diego County on October 20th. All of these are presented by Mark Bowd, the principal of Real Estate Economics. Please note, if you go to YouTube under Real Estate Economics, there's a variety of topics there. Some presented by us, and others just a variety of things relating to housing, so be sure you get the webinar you want and all of the appropriate pieces of it. This week we're going to cover Travis and Williamson counties. That's the Austin, Texas area. Later in this particular webinar we'll discuss some forecasts and trends for the Austin MSA. This particular section just covers Travis and Williamson counties. One of the things we like to do is take a look at some of the historical activity in all of these markets so we can establish some trends and put conditions on the ground in perspective back through the last cycle. This particular map shows the single month, July 2006. On the map, the blue dots show conventional resales, which we would define as owner to owner. That's a category that does include short sales when there are short sales. The green dots are builder to owner, new subdivision sales, if you will. On the map, the burnt orange is foreclosure sales. That's owner back to lender. And on the map, the yellow dots are foreclosure sales. That's lender sales to new third-party owners. Now on the bottom, in the little table, the resales are blue, new home sales are green, foreclosure, that's owner back to lender, is shown in red there with the 194, and foreclosure sales are in the purple or burgundy with the 233 sales. If you consider market conditions at this time, the national economy was doing quite well, so new home sales in this market are very robust. We'd consider 29.3% of all sales an extremely healthy figure, really showing a strong ability of builders to put product on the ground and a lot of market coverage, quite frankly. This is an area where conventional resales are only capturing about 60%. That's not a huge number when you compare other markets nationally. Foreclosures and foreclosure sales, for a baseline figure in a healthy economy, at about 9.2% total. That's a fairly high number. That ties back into Texas foreclosure law, where you can foreclose and resell a home in a much shorter period of time than you can in many other markets. That really prevented and continues to prevent an extremely rapid buildup in distressed inventory, and it just keeps homes from lying around in distressed condition for extended periods of time, like we know happens in many, many other markets. Let's come forward a full year and look at the change in character here. We've got a very slight increase in resales. New home sales remain robust, and foreclosures and foreclosure sales are still about 8%. So the market is performing better here in July 2007 than it is in many areas regionally, and this area doesn't seem to be feeling much of the impact of the initial signs of economic slowdown. Come forward one more full year, July 2008. Conventional resales again robust, 63%. New builder sales are tapering off. Prices are getting a little bit higher here. Homes are shrinking at this point in time. Values aren't quite as compelling, so new builder sales are trailing off. Foreclosures and foreclosure sales are running about 11%, as the distressed homes are really keeping up and not really building too much distressed inventory at this point in time. One more year, let's note the character changes to July 2009. The volume has come way off in the past couple of years. The resale component or percentage is high, 65.7, taking share from the new builder sales, which are now down a full 11% from 1 or 2 years previous, and foreclosures and foreclosure sales are a full 16%. So the initial signs of distress, economic distress, are showing up here. Subprime resets are showing up here, and that's manifesting itself in the distressed inventory numbers. Come forward one more year to July 2010, that's this past summer. Some of the most current information that's yet made its way through the system to us, and the resale element is still remaining somewhat high, 62.9%, but new builder sales continue to fall off, now under 18%, and the foreclosures and foreclosure sales are pulling up on 20% of total market activity. Even at 20%, this is much, much lower than most Western markets and many markets in more impacted states, Arizona, California, and Nevada. Property taxes tend to be higher in Texas than in many Western markets. That tends to discourage rental investors, so there's not quite as much rental interest in many of these markets. That led to overheating in some of the other westerly markets. Let's take a 5-year review here of what's transpired in terms of base price and value ratio. We've seen prices hold fairly steady through 06, 07, and 08. Value ratios were increasing at that point in time, so homes were becoming smaller as builders tried to maintain price points but still reduce house sizes for feasibility and economic returns. Come 2009, prices are off quite a bit, value ratios are down, but come to the most current period in 2010, we're back up about the same level that we were in 06, 07, 08, and value ratios are creeping up a bit. Somewhat larger homes are again dominating the transaction activity. Here we can really see the volume. This particular chart divides it between single-family volume, SFD, detached homes if you will, and condo volume in the burgundy. The real point here is to show the overall volume levels. What we tend to see across the West and in many of these markets is the markets that show distress later, such as the Austin area. The volumes are still coming down in a lot of these markets. In the extremely distressed markets, the volumes have already come way, way down. Short sales have emerged, and in many cases, volumes are increasing. That's really not the case in this particular area. Volumes are coming down. There's not as much distressed inventory. There's not as much short sale activity. If you live in this area, it might seem like it's been a painful couple of years with some value degradation, but in comparison to many markets regionally and nationally, this market's performed quite well. We can see that in this particular graph, housing over and under supply and undervaluation. Now this compares the percentage drop in monthly average mortgage costs since the year 2006. The entire nation is shown at the top, 38%. If you look to the bottom of the chart, the most impacted markets nationally, Las Vegas, where prices now are down in the 135,000 range, Sacramento, Phoenix, even Southern California. We've taken some big declines, but look at where Austin sits. Lack of rental investors comparatively, inability to refinance your home, do a cash-out refinance beyond 80% loan to value, and a variety of other factors. Much healthier job situation, much healthier economic situation has helped this area hold its own and really turn into one of the top performing states and MSAs in the nation. That's the end of part 1 today. Please join us for the rest of today's presentation on Austin.